Welcome to Visions and Voices, the podcast where we explore the ideas, strategies, innovations shaping the world of family offices, wealth management, and ultra-high net worth families. I'm your host, Chris Mays, partner at Armanino and leader of our family office practice. Some of the most valuable wealth our clients can hold never shows up on a brokerage statement. It sits inside of private, late-stage, venture-backed companies in the form of stock options, restricted shares, that may be worth a great deal on paper but cannot easily be sold, spent, or borrowed against. Employees, founders at these companies often find themselves in a peculiar position, rich in equity, constrained in cash, and facing real decisions like exercising options before they expire, covering the tax bill that comes with that, or simply funding life while they wait for an IPO that keeps moving further out on the calendar. That tension is exactly what today's conversation is about. I'm joined by Amrit Ravi, a co-founder and managing partner of Interlude. Interlude provides financing that lets employees of late-stage venture-backed companies unlock value from their private equity holdings without selling the shares, and importantly, without putting their personal balance sheet at risk. Amrit spent years in private equity and growth stage investing, including a partner at Section Partners, a firm whose portfolio touched names like Airbnb, CrowdStrike, Uber. Before his co-founding Interlude, he brings a practitioner's understanding of how this market actually works and where the pitfalls tend to hide. Today, we'll cover what Interlude does and who serves it, how the financing is structured and priced, the risks and protections that matter most, what the process looks like from a first call to close, and how this compares to alternatives a family or an employee might otherwise consider. Amrit, welcome to Visions and Voices.
Thank you, Chris.
So before we get into the mechanics, tell us how you came into this corner of the market. You came out of growth stage investing at Section Partners. What did you see that led you and your partners to build Interlude?
Sure. And Section Partners also was involved in this type of strategy. So we've been doing this for almost a decade now, previously at Section and now for the last 2 years at Interlude. Prior to getting into this space, I was a traditional buy-side investor. I co-ran a long-short equity fund. Prior to that, I was a principal at Riverside Company, a large middle-market PE fund. So I've had a lot of exposure to both private and public companies in the technology vertical. And honestly, when I came across this strategy, initially, purely from a return standpoint and a risk-reward standpoint, I sat back and I said, oh my God, am I missing something?
Yeah.
In terms of what the opportunity provides, what the risk-reward is for an investor. And honestly, back then, getting access to these types of companies that is otherwise really difficult to do.
Right.
Unless you're a Sequoia, unless you're a couple of big names on the cap table, it's really hard to get exposure to some of the companies we did, especially at that point in time. Companies like Airbnb, CrowdStrike, Dropbox, DocuSign, today XAI, we're looking at Cursor, Anthropic. These types of companies, it's challenging to get that exposure. And to get that in this risk-reward format, what was extremely compelling.
Yeah.
On top of that, we now, the win-win in terms of the way the structure works, which obviously we're going to spend a lot of time talking about today, was extremely attractive from both the founder or the employee receiving liquidity and what that does for them, as well as what it does for us and our fund.
So let's start simple. What does Interlude actually do for employees of late-stage venture-backed companies?
Sure. We're an investment firm focused on providing non-recourse personal financing in pre-IPO venture-backed companies for founders, executives, and early employees. We advance cash against a shareholder's private shares. They pledge those shares as collateral, but keep ownership, so they maintain 100% of their upside. So what this does is it allows these founders, these executives, to receive liquidity today or fund their stock option exercise and associated taxes without giving up any of their upside.
So how do you do that? I mean, how do you preserve the upside? I mean, how much of the downside do they own?
Sure. So the way the structure works is repayment of this loan for liquidity, for option exercise, there's no maturity date. It's triggered only by an IPO or a sale. So the way a typical transaction works, we're introduced to someone comes to us and says, hey, I'm looking for, let's say, $100 of liquidity.
Yeah.
We then go and meet with them, and we require them to pledge a minimum of 3 times that amount. So in this case, $300 worth of shares.
Yeah.
We then advance them the $100. We then file a UCC1 or take a pledge or a lien on those $300 worth of shares. And then we all sit back and wait for that IPO or that sale to occur.
Okay.
Now, one of the questions we initially get is, what happens if there's no IPO? What happens if it gets delayed? What happens if the value of the IPO goes down?
Well, let's go there in a second. Let's
Okay.
first. So what happens if there is an IPO, let's say in 12 months? So you've pledged $300 worth of shares. You've been advanced $100 worth of liquidity. So what happens? What happens next?
So they've now received the liquidity. We've, mechanically speaking, let's walk through an option exercise case first, right?
Okay.
Maybe that's the easiest way to do this. And then we can go on a pure liquidity deal. So as you know better than I do, in an option exercise case, depending on whether the options are ISOs or NSOs, there's a lot of nuances that come along with that. So in a typical deal, assuming it's all ISOs, we work with individuals who have vested on options but have not exercised.
Right.
We advance that cash to the company for the exercise amount, and whatever the associated taxes are in ISOs, we advance to the individual, which they're responsible for paying whenever that time comes in the next calendar year. At which point in time, the company then acknowledges the funds, and they receive shares.
Yeah.
We then take a pledge on those shares, and lots of times they also receive some liquidity along with that for various life events, right? School, buying a house, whatever that may be.
And they receive that liquidity from you.
They receive that liquidity from us.
Yeah. So so what you're saying is it's more than just the exercise price. It's also the taxes, and it may be some additional liquidity on top of that in order for some personal consumption.
Correct. We are honestly, once we receive our lien on the shares, we are agnostic to the use of proceeds. And the reason for that is, whatever the risk is in this transaction from our standpoint is solely linked to the performance of the shares. So one of the key things about our structure is it's non-recourse. What does non-recourse mean? It means that there's no personal obligation of the borrower in the event the company goes sideways, in the event the company does an IPO.
Okay.
It's all linked just to the value of the shares.
Okay.
So,
but I mean, if you enter in the structure, what are you giving up? Like when those shares eventually are liquid, like what do they have to pay back to you?
Yep. So the way our fees work is we charge our fees in two forms. We charge an interest rate that PIKs, meaning which it's only due upon that IPO post lockup, when they can freely sell shares to pay us back.
Yeah.
And then we charge a stock incentive fee, which is a certain percentage of the shares that are pledged to us we receive again post IPO, post lockup. So the way to think about the math is, on a typical liquidity deal, as long as the company appreciates by 1.7 times today's value upon that liquidity event, the founder or the executive would have been better off financing their liquidity with us than having sold shares to receive that liquidity. Because as we all know, selling shares to receive liquidity is extremely expensive if the company is performing.
Right.
So that's what. So if you ask me what they're giving up, they're what they're the risk they're taking is if their company does not appreciate by 1.7 times on a pure liquidity deal, again, at the time of settlement, not whenever that IPO is, whenever that lockup is, then they would have been better off having just sold their shares if it's anything below that on a cost basis.
Yeah. Okay. Well, on a time value of money basis or on a cost, so I, I want you to back into that 1.7. Like, can you, so your fee plus the percentage of shares, can you give some form of indicative terms at how you get to that
Yes,
1.7?
yes, yes. Typically, the borrowing rate starts at prime plus 3%, that
Okay.
interest rate, which again, due only if the company has that exit.
Okay.
And the share fee is 10 to 15% of the pledged shares. That's the
Okay.
range.
Okay.
So that the reason, which that's a lot of math there, and it's pretty complicated. So the way we usually explain that to a potential counterparty, a potential borrower, is we say, if you believe your company is going to go up by 1.7x on a liquidity deal, then you're much better off financing your liquidity with us
Then selling shares.
than selling shares.
Yeah.
Now, on an option deal, it's much more attractive. Now, why is that? So the biggest thing with an option exercise deal is it allows the borrower to exercise their options, start owning their shares, start their long-term capital gains clock,
Right.
and it captures that the delta they're paying is between the 409A and their strike price.
Yeah.
So every single time the 409A goes up, that's a higher tax obligation that they have.
Yes.
This avoids that. If they wait and exercise and sell upon an IPO, they're now dealing with the market price. And I'm going to walk through an example of a company to show you what that looks like. It's very case specific, but what we're seeing today with the Anthropics of the world, with the Cursors of the world, with the open AIs of the world, with these types of companies is given how fast the 409As are going up,
Right.
given how low the strikes are, it's actually even at the current market price, meaning which whatever the current value of the company is today as a private company before they've gone public, before they've had any appreciation, they're still better off financing their options with us today, paying the associated taxes and starting that clock. And that's just a
And
given.
does that but does that matter? So how sensitive is, because like if you're a California state resident and you're not getting, you're paying ordinary income on the capital gains, what's the sensitivity there, relative to being say a Florida resident where you don't have any capital gain? Is it?
Yep. It's as you said, it's definitely state dependent. Um, that break even is going to go up by whatever that state tax amount is to compensate for that.
Oh, yeah.
Now, a few things to keep in mind here. One is this does not disqualify QSBS. So that's one very important point. The second point is our transaction is deemed to be an open transaction for tax purposes, meaning which it's effectively a capital asset. So all the fees paid to Interlude is
Yeah,
a capital loss for the counterparty.
correct. Yeah,
So because settlement is timed to be when that counterparty has a big capital gains bill in their life, meaning which the company was sold for cash. The company IPO'd and their post lockup. All of these they can use the capital losses from our contract to offset their capital gains bill.
right. Yeah, I see that. Um, okay, so and you're saying the magic number is 1.7, but there might be a little bit of plus or minus variance around that depending upon what state you're in.
And the
And
fees and the company in question, what for a lot of our option exercise deal, again, with the hyperscalers, right? With the companies we've talked about, the companies we are going to talk about, the break even is not 1.7, it's almost close to whatever today's value is, meaning which it makes economic sense to move forward with a transaction with us as long as you don't believe the company's value is going to depreciate from whatever the last round is.
And right. Okay, help me understand that a little bit further. So you're saying from an exercise your options standpoint, so you're gonna have to pay
That's
tax on the spread between the strike and the 409A, and but I mean you're still gonna need some successive appreciation. I guess in order to because the escape velocity you're trying to surpass is that prime plus three and the 30 the 10% on the pledged shares, 10 to
but
15% on the pledged shares.
But there are two other factors, and I'm going to pull up a slide right now to walk through an example. But
Okay.
the two other factors that also help with that is it's not purely beating that cost of financing because you are getting the tax benefit of that, which reduces
Oh,
the overall
right. On
cost.
the options exercise, you're getting presumably you're exercising these, you're holding them over a year, and so a year plus a day, and you're getting long-term capital gains, which from a federal standpoint is knocking almost
Seven. Yep,
cutting your tax rate in half. I mean, not quite, but yeah.
correct, correct. And then on top of that, you also get our tax shelter. So the cost of financing, so you're
So
starting
the
the long-term
interest
capital.
payment, the prime plus three plus the is
The
all
share
tax
fee, all of that is a tax
tax
loss, capital
deductible.
loss.
Okay. Oh, that is kind of interesting, right? Okay. Yeah. So you're getting that benefit, and then okay. So I want to take a little bit of a digression because I went through I've been involved in vast majority of major IPOs over the last decade, and some of the nuances like ever since a couple of the initial hyperscaler IPOs where the secondary markets picked up too many shareholders, and so they were actually forced to go public. I think Facebook was in that situation where they just had too many shareholders to remain as a private company. And so subsequent to that, all of the corporate forms have restricted the ability to file UCC filings against those shares. So how do you? Because I know for specifically in like Uber's corporate resolutions, your shares could be invalidated if you pledged or hypothecated or anything. So how do you get around those restrictions?
Yeah, absolutely, absolutely. So one of the biggest things that we've done, having done this for over a decade, is we work with the companies to make sure we're not violating any agreements. So we will not move forward if a company tells us that they do not want us to move forward with these types of transactions. We will not. Now, our contracts, and again, we've been battle tested we've done over 250 of these transactions, over 50 portfolio companies, or with 25 plus realizations with the founders and the C-suite of all these companies. So we've been battle tested from a legal standpoint, from a tax standpoint, from an
Okay,
efficacy standpoint. So we do have that. Now, what I can tell you is that the contract was designed, our outside counsel is Latham. Our contract was designed. We also have an in-house GC as one of our partners and team members. We are very aware of the way shareholder agreements work. We have multiple agreements and forms depending on what type of shareholder agreement is there, what is allowed, what is not allowed.
okay,
And if it triggers ROFRs, if it triggers certain things, then in those particular cases, depending on the contract in question, we will either go and seek those waivers, depending on the company, or
yeah,
we'll use a contract that does not violate
got
that
it.
those ROFRs or anything like that. One of the biggest advantages of our structure is like a traditional secondary. Unlike, you would have to go through all those processes. You have to do all those things. You have to get shareholder approval. You have to get all the waivers necessary. Depending on the company in question, depending on the type of contract we're using, we can work with that company to make sure we're not tripping anything up.
Yeah. Okay. Okay. That's good to know. So in other words, the company they have to be okay with the structure. But
Correct.
typically the folks that you're talking to are senior enough in the company that they can help facilitate that and make that happen. Okay.
Our deal flow historically, Chris, has come from the VCs, the board themselves, the founder network. Again, we've been doing this a long time, and we've had a disproportionate number of founders and C-suite executives as our borrowers, and the larger wealth managers. So, given that dynamic, when we are entering a company, when we are having these conversations, it's usually someone at the company who has the ability, if we need it for that particular company, to be able to facilitate whatever is needed to make sure we're working
Right,
with the
right, right.
company on the up and up. I mean,
Yeah, no, I like this structure better than others because of that fact. I mean, some of the other structures, unfortunately, they rely on personal guarantees and because they can't touch the underlying shares. And I think I mean, we've seen a number of folks enter into those agreements and there hasn't been any problems, but it's because everybody's been a willing complicit participant, so you run a fund too, and so the investors that are on the other side of this, what are they getting?
sure. So we are structured as a typical venture capital fund. So we charge a management fee, we charge an incentive fee, we have long-term money, and we allocate to a portfolio of companies. So if you think about our investors, our LPs, our limited partners, what they're receiving is they're receiving access to a venture capital fund that's providing exposure to a lot of these well-known companies in a much, we believe, measured risk reward format.
Right,
So if you think about our return profile versus a traditional pure equity venture capital fund, if a company appreciates 10x, we're probably going to return 7x because our instrument, as I mentioned, is a hybrid of both equity and debt. The, what they're receiving for giving up that upside, though, our investors, because we're over collateralized, as I
yes,
mentioned in
the
the beginning of the
downside
call,
protection. Yeah,
if there's no change in valuation, we still provide a relatively attractive return to investors. And even if there's a contraction in valuation, we still return principal at a minimum and a low return. So what we're doing is we're narrowing the aperture of venture capital returns in the same companies that the traditional venture capitalists play in.
right, right, right. Okay, I get that. I see that. And you're playing you're in late stage too, right? So the companies already have momentum. They already have achieved some stability and the test of time, and they're so you can really only go into companies where the liquidity event is imminent. Like what's that window have what's the maximum that window can be?
We do have 6-year money with a 2-year extension. So theoretically, it can be 6 years to an IPO or a
Yeah,
sale. Having said that, I think our focus is on companies that are planning on some type of liquidity event within 36 months or less.
right, right,
So
right, right.
that's what we focused on. Now, have we extended that on a case by case basis? Sure. But
Yeah,
the bulk of our portfolio is going to be within that 36-month time frame.
okay.
Now, what you'll see, and we'll go through an example, but all of our references for this are people that we've done, the companies I mentioned. It's those executives and those founders who are the people who are going to talk to our new counterparties because
Right.
they've saved millions
Yes.
literally sometimes in the 20s and 30s millions by having finance or liquidity at a time that they need it or having exercised their options at a time that they should have versus waiting and allowing them to either on the personal side purchase a home when they wanted to, put their kids in private school when they wanted to without giving up any of their upside. And what you'll see is, yes, we think that narrowing of aperture of returns for investors is very good. But what it also does is it creates a really good dynamic for our borrowers.
Right, right.
Again, with
It's a
the
win-win.
overarching point being the company has to continue to perform.
Yeah, yeah. Well, yeah. I mean, yeah, a little bit's coming out of Uncle Sam in the States, right? Because
Correct.
you're basically allowing the taxpayer to get into a more favorable marginal rate, and so Uncle Sam is contributing this win-win to borrower and lender. I I fully see that. And I actually think I like the strategy better for exercising options than just providing liquidity for consumption for that very reason, right? Because you get that phase change in taxation from ordinary income into capital gains, and that could be very significant for individuals. And by the way, like one of the biggest limitations for a lot of our clients is just that they don't have enough liquidity to exercise, even though they know they should. They don't. There's no source of liquidity. I mean, it's fortunate inside of SpaceX, right, where they had regular liquidity events. But that's not the rule. In fact, that's the exception. Most companies haven't had a lot of liquidity. Pre some IPO or sale, they haven't had a lot of interim liquidity, and a lot of these companies are long in the tooth. They're way over 10 years old, and so um, being able to get some form of liquidity to exercise options, and even compounded when you're leaving the company, right? And your options expire. Like, do you actually want to get into stock before you leave because it's a good company? You're going from OpenAI to Anthropic, or you're going from you know uh, OpenAI to some other AI startup, and you want to be able to ensure that you have your shares for the long haul.
Absolutely. The typical window, Chris, is 90 days. So if you leave a company, you have 90 days to
Yeah,
figure out how to exercise your options and pay your taxes. And to your point, even 10 years ago, 5 years ago, but that much more today, that's anywhere from, 8 to 10 to $12 million tax bill, even if your option exercise cost is 500K to a million. And that's not an easy check to write out of pocket.
no, it's not an easy check. Yeah, fair, very fair. I mean, when I look at the of course we've gotten a number of clients from all of the companies that are going public in the near term horizon, and a lot of those folks they have a salary that's a couple hundred grand, and that barely covers their living costs, and yet they might have 20 to $80 million worth of options, and no possible way of exercising those options.
That's exactly right. That's exactly right. And going back to your liquidity point, I think that's something that we do tell people. If you don't have a need for the liquidity, outside of one of these reasons, outside of maybe just pure diversification or something of that nature, then you should not do a transaction.
Yeah,
You shouldn't sell and you shouldn't do this. But to your point about these companies staying private longer and longer, when you've been at these companies for 10, 15, now 18 years, a lot of life happens along the way.
totally. Yeah. So can we jump into the example and
Sure,
take a look?
sure. So
So
here's an example of an executive at Cursor. So the setup is such that he has 100,000 vested unexercised options. His strike price is $10. The current fair market value is $200. Now, we all know the news. about Cursor being acquired at a little over a $60 billion valuation. That equates to a share price approximately of 1,250. So if he wants to exercise his options today, the exercise cost of 100,000 options at $10 is $1 million.
Yeah.
And his estimated tax bill based on his state of residence and everything else is about $9 million. So what are his two options? One, do nothing. So wait and do a net exercise when the acquisition goes through and sell at the IPO. In that case, he'd be paying short-term capital gains on the spread or the difference between $10 and 1,250. His net cash after tax would be $62.2 million. Let's say he came to us and we financed that $10 million.
Okay.
So now we advance $10 million. We cover the exercise price and taxes.
Yep.
He's now pledged 25,000 of those shares because, again, it's only 3 times coverage. So not all 100,000, just 25,000 of the 100,000 of his shares. What happens? The long-term capital gains clock starts.
Yep.
He's locked in a lower taxable spread. The gains convert from short-term to long-term. Now, at settlement, what does he pay back? He pays back the settlement cost, which is the amount he's borrowed from us, plus our fees,
Right.
which is $15 million in this case.
Okay.
He receives a $1.64 million tax offset from our structure. And his net cash after tax is $71 million. Now, this is an example of where the acquisition price is known, just given Cursor,
Yeah. Yeah.
the timing is known.
Right.
But what this shows, if I can get to the next slide here. So what this is showing is that at that assumed exit, this is his percentage gain, right? Which is 14%. In most cases, and I'm going to walk through an example, as the company appreciates, the doing nothing versus doing the structure, the client continues to benefit disproportionately without taking any downside risk.
Right. Right. But where's the break even? So
Yep. The break even in this case versus selling is approximately, let's see, go back. It's at $800 a share.
okay.
So
Okay.
actually a little bit less than $800 a share. So what would have to happen here is the acquisition would have to go either not go through, which case that's fine. He doesn't owe us anything.
Yeah.
Or if a future acquisition happens, for him to lose on this transaction, it has to go at a value that's much lower than what's been contemplated today.
Right. Right. So okay. So and just remind me where we were. So his options were at a strike of 10. The
The 49A or fair market value is 200.
is 200, and then the current value under the $60 billion acquisition price translates into a share value of
1,250 approximately.
1,250. Okay, and he was break even at 800.
Correct.
Okay.
A
So
little less than 800 actually, but yes.
a little less than 800. Okay. Yeah, okay. Right. So there's risk and reward on both sides. But the benefit is the employee, there's no recourse to the employee. They're, even if the structure doesn't work out and they don't sell. I'm assuming it keeps accruing until they do sell. And so it could wipe out all of their gains at sale, but well, that would take a really long time, right? Because prime plus 3 points, I mean, it dilutes the future value, but it's still only 10 to 15% of your shares. So that's really your risk, is that the extension risk of, hey, we thought there was a liquidity event inside of 36 months, turned out it took another 10 years, and in that amount of time, that prime plus 3% erodes the value of my shares.
That's exactly right. Look, it is a financing, so there is a cost,
Yeah,
right? And that cost is what? That accrued PIK interest, as you said, a certain percentage of the incentive shares. If the company appreciates only modestly over that extension, over that time, then that's absolutely correct.
yeah.
They would have
But,
been
but,
better
but
off
hold on,
selling.
hold on, hold on. I don't mean to sell the structure for you, but there's a cost to the other side too. If the stock continues to appreciate really quickly, then by not doing it, you're paying it in tax, at least in the option exercise scenario. You're like you are the cost is borne via excess tax that you wouldn't other, because you could have phase changed your from ordinary income down to capital gains rates by using the liquidity from this transaction exercise of options.
That's exactly right. That's exactly right.
Okay.
So I'm the way I think about this is, and the way I always explain this to these founders, these executives, these early employees is, even if there's extension risk, if you don't believe your company can beat the cost of this financing on an annual basis, then this is the right opportunity to
No,
be
yeah, no. If
anyway,
you can't
right?
earn, if your startup cannot do better than prime, look,
Yeah,
prime
yeah.
plus 3 points, like
On an annual basis,
on an
yeah.
annual basis, like yeah, then it's a more fundamental problem. You
Right,
should become a lender and start lending out at prime plus 3 points. Yeah,
right.
no, yeah. So you got that fundamental trade-off there. And but it's I mean, we're oversimplifying because it's also the 10 to 15% of the shares. So you
But even with that, that cost, that appreciation and everything else is still de minimis compared to what, I mean, these companies are hyperscalers today. Let's say extension goes on and they're not a hyperscaler. Based off of what these historical companies have been compounding at an annual basis
yeah.
as a private company, let alone a public company, that spread between that and the cost of financing should be a throwaway. If the company is doing half of what, or maybe even a quarter of what it's expected to do over the next few years.
Yeah. I mean, but okay, but still, like 10 to 15% of the shares, it's on the 3x of the shares, right? So you're borrowing
Correct.
$100, there's $300 worth of shares. And so it's really 30% of, somewhere between 30 and 45% of the shares at the curreal value. Um,
Yeah,
so that is a
that's why
pretty significant load, but the reality of the maths on an exercise of options, on after a certain break even. So like there's a zone where it doesn't work explicitly. There's a zone where it just kind of breaks even, and then there's a zone where you're explicitly ahead. And the the option holder is going to have to make that decision, right? There's a
yeah,
cost to
and
not doing it. There's a cost to doing it, and it kind of depends upon what ends up in the future.
the doesn't work scenario is a scenario where it's really beyond the fact that this financing didn't work. The company is just not on the path that it should
Yeah.
be, right? So where to me, yes, and that's happened. That'll happen again. I think, and that can happen for a bunch of reasons. Company performance, valuations come in. There's a bunch of things that can come into play, right? So, and we saw that in the 2021 environment, right? Companies based on
Totally.
valuations,
Yeah.
they were still doing what they're supposed to do, but their next round or their IPOs were still a quarter of those prices. So in those scenarios, obviously they're giving up a bigger percentage of their shares than they normally would just because of what's happened. What the more realistic or the over the 10 years of doing this, the scenario that they really need to think about is the more moderate scenario, which is that middle scenario, which is the company is, I mean, if it's growing at 300% a year today, and for whatever reason, valuations still come in and its growth is starting to slow, would they have been better off having just sold their shares and instead of financing with Interlude? And that's where that math is, that what I mentioned is on a liquidity deal, it's at 1.7
Right.
times today's value.
Right. Yeah.
But
Yeah.
on an exercise like this example we've walked through with Cursor, the current price is the acquisition price is around 1,250. The break even, as I mentioned, is shy of 800.
Yeah.
So
It's
that's
kind of that in this instance, it's a no-brainer, like, yeah, okay. So totally get that. I think what I also really appreciate is that when it doesn't work out for the option holder or the employee, it also doesn't work out for your investors.
correct.
So there's symmetry there, and I do like to see that because it means that incentives are aligned. And of course, there's still counterparties effectively in the transaction, but the reality of it is that it really works out for your investors when it really works out for the option holder or the shareholder, because the company continues to grow. So in success of the company, and a continued rapid rise in its value, it's a win-win for everybody. And when it doesn't, it's kind of it's a lose-lose for everybody. So it operates and by the way, for you guys that are managing the fund too, because your carry isn't as attractive in that instance as well. Yeah.
That's exactly right. And the argument that we always say is that we're even that much more aligned than the VC syndicate that back these companies. And why is that? Because the VCs own pref shares. Founders, let alone employees, own common shares. So
Yeah.
we're subject to the same dilution, the same new rounds. We're very much in the same seat
Totally.
as the founders.
Yeah.
So that's created a lot of, I think, over the years, a lot of goodwill, a lot of referrals, and we've been fortunate to have had a lot of good outcomes despite market environments, despite ups and downs, despite all that, because we're all facing that same exact battle and decision in terms of what's going to happen next. If a company's performing, none of this comes into play. It's to your point, it's just such a no-brainer that that never comes up. In the scenarios where the company, for whatever reason, either on a individual company basis or just from a macro basis, things have pulled back, regressed, and we're facing the same issues that whole executive team is facing, let alone engineers and everyone else. And that creates a great dynamic as we build our business.
Yeah. No, I see that. Well, look, Amrit, this has been great. It's been super nice to have gotten to talk to you and the structure, and it couldn't be more timely given kind of where we are with the IPO calendar that's coming up in the next 12 months or so. And really appreciate you coming on and talking to us and sharing your specific flavor of financing and how it can be helpful to the types of folks that are our clients.
Thanks for having me, Chris. Really appreciate your time.